Brand collapse. Lehman Brothers. It was September 15th, 2008. The air on Wall Street was thick with dread. One of America's oldest and most powerful investment banks, a titan of finance, was about to fall. On that fateful day, Lehman Brothers filed for Chapter 11 bankruptcy, holding over $600 billion in assets. It was the largest bankruptcy filing in U.S. history. Our story begins in 1850 in Montgomery, Alabama. Henry Lehman, a German immigrant, opened a dry goods store, evolving it into a commodities trading firm with his brothers Emmanuel and Mayer. They started by trading cotton, connecting the agricultural South with the brothers' early workshop was a bustling office filled with ledgers, scales for weighing cotton, and telegraph machines. Henry, Emmanuel, and Mayer meticulously managed their accounts, navigating the volatile cotton market. They expanded into brokering other commodities. Their first true financial product was perhaps the innovative way they financed cotton production, offering credit and hedging services to farmers. This was revolutionary for its time, providing stability in an unpredictable market. They became indispensable to the Southern economy. Early customers were cotton planters, merchants, and emerging industrialists, drawn by Lehman Brothers' astute financial advice and capital. As the firm moved its operations to New York City after the Civil War, its client base broadened significantly. Word spread of by the early 20th century, Lehman Brothers had scaled into a formidable investment bank. They were underwriting major railway projects, financing the burgeoning oil industry, and playing a crucial role in the rise of American corporations. Their offices, now on Wall Street, Lehman Brothers became a pillar of Wall Street, synonymous with financial prowess. While not a retail bank, its influence permeated every sector. They controlled significant stakes in major industries, advising corporations and governments alike. Their brand, their headquarters in New York City, was an imposing structure, a testament to their enduring power. From these hallowed halls, deals worth billions were brokered, shaping global commerce. It represented the apex of financial ambition, a symbol of stability and Lehman Brothers' reach extended far beyond America's shores. By the mid-20th century, they were establishing offices in London, Tokyo, and Hong Kong, facilitating international trade and investment. Their global strategy was to connect capital flows, advising multinational. By the late 20th century, Lehman Brothers was ingrained in the fabric of global capitalism. Though not a household name like consumer brands, its presence was felt in every major merger, every IPO, every government bond issue. It became a trusted name for institutional investors. By 2007, Lehman Brothers stood at the zenith of its power. With a market capitalization soaring to over $60 billion, it was a dominant force in investment banking. At its peak, Lehman Brothers reported record net revenues of $5.7 billion in the second quarter of 2007 alone. Its global presence spanned over 40 countries, and its fixed income division, heavily invested in the booming real estate market, for those inside the industry. Working at Lehman Brothers was a badge of honor, a symbol of elite status and ambition. It meant being at the forefront of global finance, shaping deals that made headlines. While not a consumer brand, its name carried immense weight in boardrooms, with offices strategically placed in every major financial hub from New York to London, Tokyo, and Dubai. Lehman Brothers' global footprint was immense. It was a true world leader in capital markets, connecting investors with opportunities across continents. The fatal error began years before the collapse, around 2005. In a series of aggressive moves, Lehman Brothers significantly increased its exposure to subprime mortgages and other illiquid real estate assets. Despite internal warnings about the housing market's fragility, while other firms began to scale back their subprime exposure, seeing the red flags, Lehman doubled down. Competitors like Goldman Sachs started hedging against the impending housing crash, a move Lehman either dismissed or failed to execute effectively. The firm's leadership held firm. Publicly, Lehman executives maintained an image of unwavering confidence, even as the housing market began to unravel. Internal memos, however, revealed growing concerns about the firm's balance sheet and illiquid assets. But these warnings were often downplayed, or whispers of dissent grew louder within the firm. Analysts and risk managers issued grave warnings about the escalating subprime exposure, predicting potential catastrophic losses. Many of these voices were silenced or marginalized, their concerns dismissed, while Lehman clung to its real estate bets. Rivals like Bear Stearns, then Merrill Lynch, began to face their own liquidity crises, offering clear warnings of the systemic risks. Yet, Lehman continued to acquire more illiquid assets, convinced they could ride out the downturn. The first visible cracks appeared in late 2007 and early 2008. Lehman announced massive write-downs of its mortgage-backed securities portfolio, sending jitters through the market. Investors grew wary. Interbank lending dried up, and the firm found the stock crash was brutal. From a peak of over $80 a share in early 2007, Lehman stock plummeted relentlessly throughout 2008. By September, it was trading in single digits. Each announcement of further losses, each failed attempt to secure. As losses mounted, Lehman Brothers began massive layoffs. Thousands of employees, from junior analysts to seasoned managing directors, received pink slips. Entire departments were shuttered, and communities in financial hubs globally felt the devastating ripple. The financial press screamed headlines of impending doom. Lehman on the brink, race to save Lehman, Wall Street's next casualty. The narrative became one of a firm fighting for its very survival. The public, glued to news channels, watched in horror as a pillar of the executive departures became a grim procession. Key leaders and senior traders, sensing the inevitable, began to jump ship. While many lower-level employees faced unemployment, some top executives departed with significant severance packages, further fueling. The crisis wasn't just abstract numbers. It was visible on the streets of financial centers. Empty offices, hushed trading floors, and the somber faces of departing employees. On September 15, 2008, after frantic, failed weekend negotiations to find a buyer, Lehman Brothers filed for Chapter 11 bankruptcy. The decision, made by CEO Richard Fuld and the board amidst immense pressure from the Federal Reserve and Treasury, since the physical symbols of Lehman Brothers quickly faded. Its iconic headquarters, once a beacon of power, stood empty and eventually changed hands. Branch offices worldwide were liquidated, their assets sold off. The bustling trading floors fell silent. In a vacuum left by Lehman, competitors like Goldman Sachs and J.P. Morgan Chase absorbed much of its former business. They quickly expanded their market share, seizing clients and talent. These firms, having navigated the crisis with greater agility or government support for the employees, the last day was an emotional maelstrom. Many recall the surreal silence, the somber goodbyes, and the indignity of carrying personal belongings in cardboard boxes. The once vibrant trading floors emptied, the lights dimmed, and a sense of profound. The definitive fall of Lehman Brothers was etched into history as the moment the global financial system truly buckled. The image of its headquarters, once a symbol of capitalist might, today, the financial world operates under stricter regulations, a direct consequence of Lehman's collapse. Mortgage-backed securities are still traded, but with greater oversight. The market, once dominated by a few giants, has seen new players emerge, though the overall, for those who work there or simply witness the crisis, Lehman Brothers remains a potent symbol. Vintage bond certificates or old Lehman-branded pens are rare collector's items, imbued with a sense of history. The name evokes a complex nostalgia, for an Lehman Brothers, despite its collapse, left an undeniable mark. Its historical role in financing America's industrial growth, its pioneering work in capital markets, and its global expansion efforts were foundational. Even in its demise, it forced a global. One can only imagine an alternate timeline. What if Lehman Brothers had heeded the warnings, diversified its portfolio, or secured a bailout. Perhaps it would have transformed, adapted to the new financial reality, and continued its long history. Instead, its fate serves as what remains today are the lessons learned, etched into the very foundations of global finance. The empty spaces, the repurposed buildings, and the silence where once there was a roar of... The first lesson from Lehman Brothers is the danger of unchecked risk-taking. Financial innovation, when coupled with excessive leverage and a lack of transparency, can lead to catastrophic consequences. Never allow short-term profits to... Secondly, leadership must cultivate a culture that embraces dissent and actively seeks out uncomfortable truths. Ignoring internal warnings, dismissing external threats, and doubling down on failing strategies are recipes for disaster. The third lesson highlights the perils of complacency and the failure to adapt. In a rapidly changing market, past success can become a trap. Lehman Brothers' reliance on outdated models and its inability to pivot away from a failing asset. Finally, the story of Lehman Brothers underscores the interconnectedness of global finance. A single institution's failure can trigger a cascade of economic devastation. This demands a broader perspective, understanding that the fall of Lehman Brothers was a pivotal moment in economic history, a stark reminder of corporate fragility. Its story, like so many others,